Hi, I'm James Robinson, and this is the Robinson Stocks 2025 Annual Report to Investors. Every year I have a partners dinner in January for my investors, and we discuss what happened that year and what I think is going to happen this year and my thoughts on the market and investing. Obviously, many of my investors can't make that dinner, and so this video is to recreate what we talked about and get my investors up to speed. So first, I just want to thank all my investors for investing with me, for giving me an opportunity to manage their money. It's an honor and a privilege, and I'm humbled by their trust. I want to let them know that I'm grateful because what I'm doing now for a living is just a tremendous amount of fun for me. I get up every morning and it's a treasure hunt to look for stocks. I'd probably be doing it for free with my own money, but the fact that I get to make my investors' money while having fun is just a great benefit. Everything that I do is based on the way Warren Buffett set up his partnership in 1956. So even though I'm a registered investment advisor, and even though your money is with Schwab, I treat it and behave and think about things as if we were partners, like Warren Buffett's limited partnerships, the Buffett partnerships. So again, while everybody's portfolios are independent of each other in terms of they're in their own accounts, they are all managed exactly the same. Fundamentally, what I do is I invest my money the way I would invest it in the companies that I think make sense, and all of my clients' money is then invested the exact same way or as close to the exact same way as possible. So next, we're going to talk about our results for 2025. We're going to talk about what I do to find good companies, and then I open it up for a Q&A, which obviously won't be able to do in this video. My job, and I spend 100% of my time or 90% of my time focused on finding and researching great companies. That's all I do all day, every day. And by the way, many of the great companies that I find are too expensive right now to buy. And so we just track them for another day when they get cheap. But literally every day I look at a few companies and try and figure out what's behind them and if they're a good buy or not. My next job, and believe it or not, my most important job, is to ignore the noise. The stock market is constantly giving you feedback which is not relevant or not important. I also try and ignore the macro economy. I'm just looking for great companies, and I feel if we can buy great companies at good prices, then in the long run, those companies will make us money, whether the economy is in a boom or a recession. Again, if you look at Walmart or Apple or any of the great companies that we've had, it really didn't matter what's happened since they've been founded. The companies have done well. My fourth job is to just have a lot of patience and most of the time do mostly nothing. I buy stocks very rarely. I sell stocks very rarely, many times going several months without buying or selling anything. And that goes back to my original philosophy, which is if I was a perfect stock picker, I would buy 10 stocks day one, and they would be the Apples and Walmarts and fantastic companies of their day, and we'd never sell them and we'd all buy jets. Obviously that's hard to do, but the goal is to spend more time doing research and less time buying and selling stocks every day. So I'm going to give the results for 2025, but before I do, I need to give some explanation. These results are based on my portfolio. My portfolio is the model that everybody else's portfolio is based on. However, many of my clients add money at various points during the year. They'll take out money at various points during the year. And that will skew their results. If they buy at the right time, their results will outperform me, and if they buy it at the wrong time, then in the short term, their results might underperform me. But if you keep your money with me for a very long period of time, your results should more and more closely mirror what we're doing. So again, you might be off by 1% or 1.5%, positive or negative versus these numbers, but they're a good baseline. So for 2025, we were up 14.41%. It's a good number. I'm proud of it. It's not a spectacular number, but we're not going for spectacular numbers. We're trying to be invested in really, really good companies, bought at really good prices, which will grow in the long run. We're not looking to double your money. We'd much rather take a few less points of profit in exchange for reducing your risk dramatically. And I think as you watch this video, you'll come to recognize that we really do have your risk reduced dramatically relative to most of the companies you might consider buying. The idea that we gave you the results for 2025, and that's the accurate number, that's the real number. Having said that, I just wish the year had ended a little bit later. We're up about 5% for the month of January. So if I had managed to do from January 1 to January 23, from January 1 of 2025 through January 23 of 2026, which is almost 13 months, we'd be up almost just over 20%, which annualizes out to a rate of 19.08%. So, you can have these swings of a few percentage points, which can dramatically change your numbers. The important thing to keep in mind about that number is that over that same period of time, from January 1, 2025 through 23-26, the S&P was up 17.84%. So I didn't exactly beat the S&P 500 January to December, but January to January, I did beat the S&P 500, and I beat it by 1.2%. So I'm very proud of those results, especially when you look at those results in the context that I believe that you'll recognize and agree our portfolio has far less risk in it than the S&P, and especially we have less risk than the Magnificent Seven, which is dominating the S&P 500 right now. As evidenced by the difference between the January to December number and the January to mid-January number, short-term results can vary dramatically. You want to be measuring these things in a much longer period of time. So from the day I started this business of January 1 of 2023 through 12/31/2025, 3-4 years, we're up 15.82% on average each of those 3 years. $10,000 invested in 2023 would be $15,464 today. So we're up about 54% cumulatively over the time that we've been investing together. The magic of compounding is important to remember. A 15.8% return compounded for 25 years turns $10,000 into $393,000. And as we're investing, we want to be thinking about that long-term approach. And that's why I'm trying to run our money conservatively. It wouldn't make much difference if we were up 20% every year if we then have a year we're down 50%. And that can happen. So we're being very conservative, and despite being very conservative, and despite not investing in, Magnificent Seven stocks and Palantir and Tesla and these really high-flying companies that have done spectacular and really carried the market over the last few years, we're still up, almost 16% a year for 3 years running. Here's another way to put our investment results into in a framework that might kind of interest you. Our youngest investor is 11 years old. His name is Vito Tronsolito. By the way, I'm sharing these numbers with his parents' permission. Vito has $8,876.27 invested with me today. He's 11 years old. If he was able to compound at 15.82%, then in 54 years, when he turns 65, he'll have $28,597,385.98 in his account. So again, 15% compounding for a very long period of time can be wonderful. I hope that I'm around in 54 years and able to accept his congratulations as he is, living a life of first-class travel and big houses and country clubs. Over the short and medium term, stock profits can vary relatively dramatically. Dividends, however, are cash that are paid to us as the owners of the various companies in which we own stock. Again, there's a little oversimplification, but when you own stock, you own a piece of the company and you're entitled to a piece of the profits. Good companies will pay some of those profits to their shareholders. When they're paid to you, they're paid in a tax-advantaged way. They're taxed as long-term capital gains, not as income, despite the fact that you often will get that money quarterly. And so I value dividend income. It's a way of taking money out of one business, and then I will reinvest that money in whatever I think is the best investment at the time. But it's money that can never get taken away from us. Once the company has paid it to us, it's ours. If we leave the money in the stock and something bad happens to the stock, it doesn't really matter how high it went. It only matters what the price is when we sell it. We have the S&P 500, the 500 companies of the S&P 500, pay cumulative dividends. Their dividends were equal to about 1.15% of what was invested in 2025. This is the lowest dividend yield in history. This is very low yield means that the company's profits aren't very high relative to the stock price. And that's one of the signs that we're going to point to as we go through the rest of this for why the market is overpriced. This is the lowest yield that the S&P 500 has ever had in history. Last year was the second lowest it's ever had in history. Historically, it's closer to 3.5% is what the dividend yield of the S&P 500 is, which leads you to believe the S&P 500 is at least 100% overpriced. Our dividend yield for the year was 4.1%. And so we earned about 350% of the yield paid by the S&P 500 companies. And again, I believe we've done so without taking the risk that you have inherent in the S&P 500. In the short term, the knee-jerk reaction is to measure my work product based on the returns that we make. There will be years that I make really good investments where the market turns on us and we might lose money or not do very well. That doesn't mean we didn't buy great companies, and it doesn't mean we didn't do great research. It just means that sometimes it takes time for that research to work out. And when the tide's going out, all of the boats sink, even the really good ones. So I always try and encourage my investors to measure me based on my work product. In 2025, I analyzed 455 companies. Now, to put that in context, that doesn't mean I spent 20 hours on each of those companies. What it means is that I did a preliminary deep dive into the company's financials to find out if that company is worthy of more research. So currently, I have done that level of research with 1,632 companies. I've actually done over 2,200 companies, but over the last 7 or 8 years, some companies go bankrupt, some companies go private, some companies get merged into other companies. And so the number of companies is always changing. But the current number we're tracking is about 1,632 companies. Of those 1,632 companies, I started the year January 1 with 223 companies that I thought were cheap enough that I would buy them at the right price. I ended the year with 257 companies, which I felt were cheap enough to warrant buying at the right price. Overall, 16% of all the companies I've invested in that I've researched turn out to be investable. So 85% of my time I'm spending looking at companies that just have no appeal to me as an investor, but there's no way to know that without doing the homework. And the other thing to keep in mind is that I am learning as I'm doing this analysis. And oftentimes I will get a sense for what's happening in an industry because I've looked at 6 or 7 companies in the industry. And then when I find a stock that might be a great buy, because its financials are really good, I can look at it in the context of not just what's happening with that individual company, but in the broader scope of the industry in which they work. Of the 257 companies, 53 of those companies I would be cheap enough for me to consider buying. So it's about 3.24% of the companies that I've researched. Last year, about 2.3% of the companies I researched were worth buying. So prices have come down in many of these companies. And so these are the 53 companies where I'm likely to spend most of my time. I'm really trying to understand these 53 businesses. All of them theoretically should be something I would purchase. All of them theoretically are cheap enough to buy. And my job is to filter through those 53 and figure out which 10 or 15 make sense for our portfolio. Currently, we own 13 companies. So less than 1% of all the companies that I've researched ever make it into our portfolio. Just to give you a sense of scale, these are the 455 companies that I researched this year. Historically speaking, investors like me have been measured by our ability to perform relative to the S&P 500. So the S&P 500 is what's called the benchmark. I believe that the S&P 500 today is no longer a proxy for the American economy. I don't believe it's a fair way to measure investment results. And I want to go over why that is. And this isn't sour milk. I'm not saying I shouldn't continue to be measured by this. I believe that all of the things I'm going to talk about now are structurally wrong with the market, and I believe it's going to correct. And in the next few years, I think I'll look great relative to the market. But here's what we're facing in the S&P 500. It used to be a proxy for the American economy. But today, it's contaminated and dominated by a few companies in one industry. It's no longer a broad measure of what's happening. It's really a measure of what's happening to a few companies that are all operating in one space. Those 7 companies are Apple, Google, Tesla, Microsoft, Nvidia, Amazon, and Meta. Together, those 7 companies make up 35% of the S&P 500. And they're all effectively in one industry, technology, and to a smaller extent, they're all really also in AI. To put that in context, the bottom 100 companies of the S&P 500 make up only 3.5% of the influence of the S&P 500 results. So you have these 7 companies in one industry that are 10 times as important as the bottom 100 companies that are, by the way, those 100 companies are equally diffuse amongst all industries. Nvidia alone is twice as powerful in its ability to affect the market as the bottom 100 companies combined. And the companies in the bottom 100 are companies you've heard of: Ralph Lauren, American Airlines. I mean, solid, large American companies. The S&P 500 was up 17.4% in 2025, and that sounds great. But if you take out the overweighting of these high technology companies, and you just say, let's make all 500 companies equally valued, equally weighted, then the S&P 500 will only be up 9.3%. And let me talk about the weighting for a minute. So the S&P 500, every company doesn't have an equal influence. The influence your company has in the S&P 500 is related to the market cap, the amount of value your company has. So NVIDIA's market cap is $4 trillion. The bottom company, the S&P 500, is like $5 billion. So NVIDIA is 1,000 times as big, and therefore it has a very much larger percentage in the index. But what's happened is those companies have done extremely well. They're all solid companies. But on top of doing very well, they've been bid up and they're trading at extremely high multiples now, multiples that aren't probably consistently sustainable. So that's why you have this imbalance in the S&P 500. To give you another sense, the S&P 500 has existed for over 100 years. The average S&P 500 PE ratio over the last 50 years is 18.7. Today it's 31.39. So today the market in total is 167% above where it normally is, 167% of the average. And again, almost all of that is these 7 companies. If you look at these 7 companies that make up the largest share of the market, they have an average PE ratio of 73. So the historical average for the S&P 500 is 18. These companies are 75. So they're 5 times as high as the PE ratio for the S&P 500 has historically been. I don't believe that's sustainable. And again, we talked earlier about dividends. The dividends are, the lowest they've ever been, which is yet another indication why this market is generally overpriced. So I want to move on from my results and from talking about the S&P 500, and I want to talk about what my real job is, what I spend my time doing on behalf of my clients. And I'm going to do this because nothing I do is hard. Nothing I do is complex. There's no magic math. You don't have to know calculus. You can almost do everything I do with a handheld calculator. I obviously use a spreadsheet, but my point is there's nothing in here that is beyond any of you. The difference that I have is I have a framework that I work from, which has been taught by Warren Buffett and Charlie Munger and Ben Graham and other value investors. And the second thing is that unlike most of you, I really enjoy this. I like doing the research. The advantage that I have is that you would be bored out of your mind doing what I think is interesting. It's really just that simple. I also think I have a temperament to be a little contrarian, which helps because, if you're gonna buy stocks low and sell them high, by definition to buy low, you have to buy them when no one else wants them. So you have to be able to look at things without following the herd. But what I want to do is give you a sense of the way I think about things, and hopefully that will give you some confidence as you're considering investing money with me, or hopefully more money with me. So Charlie Munger talks about a lattice work of mental models. And the idea is the more things that you gain excellence in, the more different perspectives you can bring to solving a problem. And one of the clients that I had when I was doing real estate was the second largest blood bank in the country. And I got to know their president a little bit, who was a hematologist. Now, a hematologist is a doctor who specializes in blood. And I remember saying to him, why would you get into that? It seems like a very strange, field of medicine to get into. And he said something to me that I thought was very fascinating. He said, James, hematology allows you to diagnose clients at a distance. I can figure out what's going on with people without ever meeting them, without ever touching them, without ever putting a stethoscope on them. And I can do it with a high degree of certainty and a high degree of confidence with all kinds of different medicines. So here's 3 examples of what you're able to do through hematology and how to diagnose things using what we'd consider without ever touching the client. So imagine you don't know if you have diabetes. The doctor doesn't know if you've had a heart attack. Doctor doesn't know if you're pregnant. Well, for diabetes, there's a blood test. There's a couple of different tests. You look for elevated blood glucose, or you can look at their A1C test, which is a long-term marker of how high their blood sugar has been. If those tests come out the wrong way, you have diabetes. It's that simple. We don't have to check your insulin level. We don't have to look at your pancreas. We don't have to look at your kidneys. We don't have to look at any of those functions. We simply know if your blood sugar is too high, you have diabetes, and the only way to do that is without touching the patient with a blood test. When you have a heart attack, the way the doctors figure out if you have a heart attack is a cardiac troponin test. I'm not a doctor. The situation is troponin is a protein that's released into the blood supply by a damaged cardiac muscle. It's really the only way for troponin to be in your bloodstream. So if the doctors suspect you might have had a heart attack and they take this blood test, they know for sure you've had a heart attack. Pregnancy, again, there's something called HCG, which is a hormone released by the placenta when a fertilized egg implants the uterus. So what I'm saying here is that there is a situation going on, and there are symptoms that can be used to identify that situation, which aren't readily obvious if you don't really think about it and spend the time to understand it. And it's that sort of the model that I use as I'm analyzing companies. So obviously there's an awful lot of blood tests that you can take, and they all test for different things. And if I asked you to help me come up with a list of things that we could use to diagnose a great company, and we sat down and we spent an afternoon thinking about it, we would come up with a number of really good measures. We would say, well, what are the earnings, and are the earnings going up? That's pretty obvious. We would say, what are the gross margins? Is the company able to generate a lot of profit out of every dollar of sales? We would ask, what are the revenues doing? We might ask, what are you spending on research and development? Or what are you paying in dividends? Or how many shares are outstanding? We could come up with that list. Well, over a number of years, and as a result of a lot of research and a lot of thought, I have a list of 29 things that I think help me determine if a business is a good business. Now, no one thing on this list is important, and no company scores high in every one of these categories. Every company has their weaknesses. Some of those are driven by the industry they're in, some by the quirks of the ownership. But what does happen is every time you look at one of these facts and you look at them in the context of thinking deeper about the problem, you start to get a general idea of what's going on with the company. And it starts to really illuminate the situation in a way that wouldn't if you just read the annual report, for example. So what I'm going to talk about now are 5 of these categories and what I can learn from these categories and what you could learn from these categories if you care to do the research that I do. So the first thing we're going to talk about is debt. In today's business world, very few people look at a company's balance sheet. Very few people consider the debt. It used to be in Ben Graham's day that one of the ways you figured out the value of a business was to look at the book value of the business. And the book value is simply all of the assets minus all of the liabilities. We don't really do that anymore. Today, most businesses are looked at based on the earnings of the company. If a company earns a certain amount of money, then we'll pay some multiple of that earnings for the value of the business. And we don't really care whether that company has a lot of assets to offset that value. We simply care about, can they consistently earn the revenue? Can they earn the income? But I believe an awful lot can be learned from looking at debt, which is why I spend time looking at it. And this next few slides are going to illustrate what you can learn that maybe you didn't think about, and then assume that there's an equal number of things that can be learned from all of these categories. So when my job is to protect my clients' money at all costs and then earn money secondarily, debt is a very important diagnostic tool. Number one, a company cannot go bankrupt if it has no debt. The only way to go bankrupt is to have more debt than you can service, more debt than you can pay off. And if you have no debt, you can't go bankrupt. So that's a very important thing to know. The second thing is the more debt a company has, the more risk should be associated with it. No matter how good your company is, no matter how high flying they're always in a competitive market. The economy can change. Your company's products may no longer be the best. And if they have too much debt, they can get into trouble very, very quickly. The next thing to know is that the more debt a company has, the more its earnings will be impacted by its interest payments. That's obvious, but effectively what's happening is the bank is your partner and they get paid first. And the more debt you have, the more they get paid first. And it doesn't, for some companies, you don't have to lose very much in earnings for the interest to be gobbling up all of the profits that are left. And now the bank's making money and you're losing money. And again, that leads to bankruptcy in the long term, but even in the short term, it can be damaging. The next thing to think about is that if a company has debt, that's money that will eventually be repaid, at least hopefully. And that is also money that is, because it's being paid to the bank, isn't being paid to the shareholders. So we have these four things that are happening when we take on debt that maybe you haven't really considered. Number one, you might go bankrupt. Number two, you certainly have more risk. Number three, your earnings will be negatively impacted. And number four, you're going to have some percentage of your future income that are not going to go to you, it's going to go to your banker. But that's only looking at debt as first level thinking. If we spent that same afternoon talking about debt and trying to think about what are the unconsidered ramifications of having too much debt, I think we'd come up with some other issues that we might consider. For example, it's very, very hard to be debt-free. Very few companies are debt-free. In the S&P 500, of the 500 companies in the S&P 500, at any given time, 15 to 20 of them are debt-free, almost none of them. So if you've got a business that's totally debt-free, they must be doing something right. Number two, having no debt implies a company does not need significant capital to maintain or expand operations. Consider that you're Tesla. Tesla wants to build a new factory somewhere. That might cost $2 billion. Well, that means that if Tesla wants to increase production, they have to spend $2 billion. Compare that to a company like See's Candy, who has a factory with a couple of vats in it where they make their chocolate. The cost of increased production is a new vat. It's irrelevant in the stream of the business. So we want to look for companies which have relatively small demands for capital, especially capital to maintain, but also to increase operations. And so having no debt implies your company is more likely to be in that category, which makes it more attractive. Number three, having no debt implies the company's CEO is not a risk taker. This is important. If you've got a company that has no debt, has some cash in the bank, and the CEO doesn't go out and borrow money to go do some acquisition or starts a new crazy idea, that tells me he's pretty conservative. I like conservative CEOs. I don't want risk-taking CEOs. That's not the model that I'm doing for my investors. Number four, having no debt means the company has dry powder when opportunity arises. If something comes up and you've leveraged up all of your business and your balance sheet, then when a great opportunity arises, whether it's buying a competitor or getting into a new industry or building that new factory or buying a new piece of real estate because it comes on the market, well, if you're already loaded up with debt, you don't have the ability to do that, or at least you have a significantly diminished ability to do that. So we like it when our companies have dry powder to react favorably and aggressively when things turn in their favor. The next thing is having no debt means your company will get better terms when you need debt. Again, if your balance sheet's already loaded up, they might loan you money. You might go to the market and bond market and get money, but they're going to look at your balance sheet and they're going to want higher yield and higher returns. So again, having no debt means lower future cost if you ever need it. Having no debt means the company is more likely to be a low-cost provider as it has no debt service. So consider that you've got two companies. One's an oil company that has no debt, and one's an oil company that has a tremendous amount of debt. Well, if the price of oil drops suddenly, then the company that has all the debt has to pay all the cost to produce the oil, plus all the cost of interest, before they can make any profit. You only have to pay the cost of production. So you will be able to provide oil to the market cheaper than your competitors. And that means that eventually you may be able to buy your competitors, or at the very least, you'll be the only one making any money. Having no debt means the company will be more likely to survive than its competitors in rough times and will earn more money in sales in the good time as it has no debt service. So again, using this analogy of the oil company, at some point this oil company with the debt service and low revenues because of lower oil prices, at some point that company will go bankrupt. And meanwhile, while that company can be going bankrupt, you can still be making money. And then when things turn around and the oil prices increase, you're going to be making more money than your competitor because none of your profits are going to interest expense. Finally, having no debt means the amount of the money the company can return to the shareholders is greatly increased. If you have no debt, you don't have to pay your bank interest, you don't have to pay them bank money in the future. That means we, the shareholders, get more money. And the only reason we're investing is to make sure that us, the shareholders, get the maximum amount of money possible. So I think when you consider that not many investors even look at the balance sheet, and then you look at the balance sheet the way I look at the balance sheet, which is as a tool to help me gain information about the way the business is run, and then you think about that fact that we're doing that in multiple different categories, you get a sense for why hopefully our treasure hunts are going to, in the long run, generate better returns. So as I alluded to earlier, being debt-free is really hard. Being debt-free is really rare. There are 15 or 20 companies that are debt-free in the S&P 500 at any given time. So why is there a range there? Well, today a company that has no debt might borrow money next week, and then the next quarterly report, they would not be debt free. Some other company, which is currently has a little bit of debt on their books, might pay that debt off and then they would be debt free. So this is a revolving door. It's not the same 20 companies every quarter. And when there's 500 companies, companies get bought up, companies get sold, companies get merged. So that's why it's a range of companies here. So here are the 13 stocks that we own, and we've spelled out the long-term debt for these 13 companies. So again, 15 or 20 of the 500 companies in the S&P 500 have no debt. 8 of my 13 companies have no debt. And the 5 that do, you can see in the next slide, it's a relatively insignificant amount of debt. And so we'll talk about that next. So this slide is looking at the stocks we own, and it's not just looking at the long-term debt. We've added in a column for the company's cash. And in this case, cash means cash and marketable securities. We've also included the market cap, which is the total value of the company. The market cap is actually the total number, it's in dollars, but the debt and cash are in millions of dollars. So when you see $42 million or $42 in the cash column, that's $42 million of cash. So in the case of Risk Industries, it's an $88 million company with 50% of its value in cash. That's pretty strong. Even Omegaflex has 46 billion in cash, and it's a $330 billion company, and can see on down the line. But the second point to make here is that a lot of our companies which have debt actually don't have any net debt. So Warrior Met Coal, for example, has 153 million in debt, but it has 506 million in cash. Cognizant Technologies has 875 billion in debt, but it has 2.2 billion in cash. So of our 13 companies, 8 of them have no debt whatsoever. Of the 5 that are left, 3 of them could write a check tomorrow and pay off all of their debt and still have cash left in the bank. So really 2 of our companies have net debt. One of them is Atcor, which is a $2.3 billion company, has 700 million in debt and 300 million in cash. And the other one is Altria, which makes Marlboro cigarettes, and that has a lot of debt, 23 billion in debt and only 3 billion in cash. That's the only one of our companies that isn't, a 10 out of 10 in terms of financial strength. This next slide looks at what we just talked about, and it looks at your net cash. So if you took all of your cash on hand and used it to pay down all of your debt, how much cash would you have left? And you can see that only 2 of our 13 companies have a negative cash position, Atcor and Altria, and the rest of them have very significant net positive cash. Another way that you can look at cash and debt and look at the security of your company's debt is by asking yourself, how many years income would it take to pay off all of your debt? So of our 13 companies, 8 of them, of course, have no debt. There's nothing to worry about. But if you didn't want to use your cash to pay off the debt and you wanted to use this year's profits to pay off the debt, how many years' profits would it take? So Warrior Met Coal could pay off all their debt in 6 months. And the worst of our companies, Altria Group, could pay off all of their debt in 2.5 years. So $23 billion in debt sounds like a lot of money, but it's not a lot of money when you're a $100 billion company and you're making whatever it is, $9 or $10 billion a year in profits. So that's one of the ways you look at debt is you look at it, how big is the number? How big is the number relative to the market cap of the company? How hard would it pay off all your debt? And finally, how long would it take to pay off the debt using profits? And the point I want to make here is that owning these kinds of companies that are this secure, that are this absolutely bulletproof in terms of their balance sheet, we're able to own these super safe companies and get a 14.4% return. Now, I know I can buy the S&P 500 and I can get a 16% return or 17% return, but there's a lot more risk associated with that. You're buying a market which is 150% or more above its historical average. It's paying dividends of half of their historical average. You've got that entire market, which is 35% biased to a few very large companies in one industry. It doesn't take very much for that to go wrong and you to not have a good year. But we've got these 13 companies in very diverse industries, and every one of them is a fortress balance sheet. So let's talk about our businesses and what they do. George Risk Industries makes security systems for your house. Omegaflex makes steel tubing, which is used in plumbing and gas transmission, not gas like your car uses, but gas like oxygen is a gas, and not like dentists would use it to take nitrox. So that's they're making this flexible tubing, which is used for that process, and it's cheaper to install than regular plumbing fixtures would be. Value Line is a data service which gathers information for investors. Marine Products makes speedboats. Cal-Maine Foods is the nation's largest egg manufacturer. And let's talk about Cal-Maine Foods. So Cal-Maine Foods is a $4 billion company. They have 54 million chickens that lay 2 billion eggs a year. They own 40,000 acres of farmland for the use of their chickens. They have, I believe, 42 individual facilities. So if avian flu strikes one of their facilities, they have 41 other facilities to make up the gap. They have 17 million pullets, which are chickens which are not quite ready to lay eggs yet, that are in different facilities from their other chickens. And so if, again, the avian flu wipes them out, they can get back online pretty quickly, which is one of the reasons why you own the stock. SEI Investments is the back office for a lot of brokerage software type services. Deckers makes UGG shoes and Hoka shoes and other, they make Tevas, things like that. T. Rowe Price is sort of another company like Schwab, which allows you to buy stocks online. Warrior Met Coal makes, so there's two kinds of coal. There's thermal coal, which is what most people are familiar with. Thermal coal is used in the making of electricity. Well, there's another kind of coal, which is called metallurgical coal, and that's used in the manufacture of steel. So when you're making steel, you need to get rid of the oxygen, and the way you do that is through a process called the Bessemer process, and that process needs carbon. And there's not many sources of carbon. One is diamonds and one is coal. Coal, it turns out, is cheaper, and so that's what they use. But where I'm going with this is the world doesn't like coal because I think it's dirty energy, and so everybody hates the coal industry. It doesn't matter whether the world likes coal or not. If you want steel, you have to have metallurgical coal. So you're insulated from these the green concerns that people have about regular coal. Atcor is the biggest problem in the AI industry is that you have to generate a lot of power to make it work. And Atcor is a company that makes electrical components for power transmission. And so they're effectively the company that is making the shovels for the miners of AI. Cognizant Technologies is, they're the company that's like back office IT support for large corporations. Snap-on Tools is a company which makes wrenches, and they sell directly to, I say wrenches, but all kinds of tools. And they sell directly to, mechanics and the people who need tools. And then finally, Altria Group makes cigarettes. So what you see is we own 13 companies that are tremendously diverse over a large number of industries, and we have a rock solid balance sheet. The next thing that I want to talk about as we're looking at how I evaluate companies is I want to look at our ability to, one of the things I look at is a company I'm going to buy, how good a job does that company do in terms of allocating capital? So what does capital allocation mean? When a company earns a profit, they have to do something with that money. And what they do with that money can determine the long-term benefit to the owners of the company, in this case, the shareholders. So in 1965, there was a textile mill called Berkshire Hathaway. It was never a very good business. Warren Buffett bought it because he thought it was cheap, but he didn't buy a great business. But what he did do is he allocated the profits, what meager profits there were, into other businesses which were very strong businesses. So 100% of its value today is the result of the way Warren Buffett allocated capital. The profit has nothing to do with the textile mills. In fact, the textile mill closed in 1985. So Warren Buffett buys the textile mill in 1965. He takes the profits and he puts them in something other than a textile mill. 1985, they sell the textile mill, and today the company is worth $1 trillion. He bought the company, the entire company, for $22 million in 1965. So that entire $1 trillion was not because of textiles, it was because of the way the capital is allocated. Not many people spend much time thinking about the way their investments allocate capital, but I think that you should. And so let's talk about that with some of our companies. So there are exactly 5 things that a company can do with their profits. The first thing is they can retain those profits and reutilize them in the operation of the business, either to expand, to buy other companies, to build new factories, to do research and development. Whatever they choose to do, one of the tools that is available to management is to retain the earnings. Another thing they can do is pay dividends. That's where they give money directly back to the shareholders. We like that. Another thing they can do is buy back stock. That is indirectly benefiting the shareholders. We like it when they do that. You can reduce debt. We've talked about having no debt is better than having lots of debt, so I don't mind when the company takes their money and uses it to reduce debt. The final thing that a company can do is they can use it to increase cash reserves. That isn't as sexy to me. Obviously, it makes your company safe, but you want to make sure they have a long-term plan for their cash and they're not just holding it for the benefit of holding it. So what this slide is looking at is the dividend yield that the companies are paying us. So the first of the 5 things that we just talked about, the first one we're going to analyze is dividends. And so here you can see the yield that each of these companies paid. So just to give you a sense what yield means, if you owned $100 of Cal-Maine Foods, every year they'd give you $9.57, right? If you owned $100 of Snap-on Incorporated, every year they'd give you $2.66. And so we look at that yield as return to the investors. It's in our pocket. The good news is it's tax advantage. We're not paying income tax on it. We're paying long-term capital gains, which is typically 15 or 20%. Now, some of these are much higher than others. Some are at 9% and some are at 2%. I don't just look at dividends. I'm not a dividend investor, but I give preference to companies that pay a dividend. And these all averaged out last year to about a 4.1% return. You'll see that Deckers down here pays no dividend. Not the end of the world, doesn't necessarily bother me. And one of the things you're going to see as we go through the next slides, that every company has some things they do well and some things they don't do as well. Cal-Maine Foods here you see pays a 9% dividend. That's excellent. They may not be the best in all 5 categories. They may even be below average in some of these categories. The idea is to look at all 5 categories and make sure that in general, they're doing a good job with capital allocation. So again, we talked about there are 5 things you can do with your profits. Number 1, we're going to talk about is dividends. Our portfolio, as it's currently set up with the current stocks we own, pays a dividend yield of 3.7%. Just to put that in context, 1-year treasuries are 3.5%. So you can take your money and you can buy treasuries. You're guaranteed to get your money back. You're also guaranteed to get exactly 3.5% back. Or you can buy stocks with us and you're going to get a 3.7% yield and you're going to get all the potential appreciation of the stocks that you own. And again, you've already seen the balance sheet of the companies we own is such that you should feel pretty secure those companies are going to be there next year and going to continue to pay the dividends. This next slide is looking at the buybacks for these companies. And so the number of shares is in millions. So Atcor bought back 11 million shares, and this is over the last 5 years. So Atcor's bought back 11 million shares over the last 5 years, and that's 23% of the company. So without buying another share, if you had just held the stock over the last 5 years and you'd bought 100 shares, you'd have the equivalent as if you bought 123 shares without paying for the extra 23 shares. The company paid you that by buying back other shareholders and increasing your position hold in the company. So we like that. The great thing about this is it's tax advantage. You pay no taxes on the fact that you've got 23% more of the company. And that's one of the reasons why companies will do this instead of paying a dividend. And then you see SEI Investments bought back 14.6% of the company, which is 21 million shares. And you can read on down the list. Now, if you remember on the last slide, we talked about how Cal-Maine Foods paid a 9% dividend, and we thought that was great. And here you can see that what they didn't do is buy back any shares. In fact, they actually issued 345,000 shares over the last 5 years. Generally, when a company does that, and it's a very small amount, Marine Products issued 500,000 shares. Those are shares that are being paid as bonuses or as options to their top performing executives. I don't really have a problem with it. I'd prefer they buy back shares, but it's not the end of the world. Omega Flex and Warrior Met Coal bought back no shares, but you're going to see Warrior Met Coal, for example, when we talk about it in a future slide, has done a tremendous amount with their retained earnings. And that just highlights this idea that there's no one rule that works. You want to understand all of them sort of in relation to each other. So when you look at buying back stock, in total, the companies in our portfolio buy back about 1.1% of the value of our portfolio. The shares are bought back every year. So that's an additional 1% of what we'll call deferred benefits for owning the company. And over time, that number would add up and create value for us. So here what we're looking at is the debt reduction and the increase in cash for the companies we own. So, you know, the item 4 and 5 is, did the company pay down debt or did the company increase cash? So when you look at Altria, for example, remember Altria has about $23 billion in debt. Well, 5 years ago, they had $30 billion in debt. So one of the reasons that I'm willing to buy a company with that much debt is, first of all, they can pay it back out of their earnings without much problem in a short period of time. But secondly, what I know, and you didn't know yet, but you do now, is that the company has bought back almost $7 billion worth of their debt in the last 5 years. So the debt number is being managed and being controlled by the company. They're not in a situation where they have $23 billion worth of debt and they're continuing to take on debt and make the problem worse. And that's just one of the things you figure out when you're analyzing the balance sheets for the company. They did use $1.8 billion in cash. They did decrease their cash by $1.8 billion, which is a bummer, but net, their cash in their balance sheet increased by $5 billion. $6.8 billion in debt reduction minus $1.8 million of less cash is a $5 billion benefit to the shareholders. Most of our companies don't have the option to pay back debt because they don't have any debt. But again, look at Cognizant Technologies. They had a net increase in cash of negative $481 million, but they reduced the debt by $574 billion. So they made a net benefit to the balance sheet of $93 million. And the neat thing is, of the 13 companies we own, every single one of them made some significant or at least reasonable increase in their net balance sheet value by paying down debt and or accumulating cash. So our stocks, if we'd owned them all for the last 5 years, would have paid down a net of $7.3 billion in debt for the last 5 years. And think about how significant that is. We would have paid down debt of $7.3 billion in 5 years. And 8 of our companies don't even have any debt to begin with. So that's a pretty significant number. In addition to that, our portfolios increased their cash position by $571 million. And that's in addition to buying back 1% of the total shares of our portfolio. And that's in addition to paying us a 4% dividend. So our total balance sheet improvement, cash and debt, was almost $8 billion over the last 5 years. So let's go to the last slide. And the last slide is return on retained earnings. So when a company keeps money and doesn't pay it back to us in any of the other 4 ways, we would expect that money that they keep is being used to benefit the shareholders by increasing future profits. The problem is sometimes that increase can occur significantly in the future, and it's hard to figure out if the increases came as a result of the retained earnings or as a result of some other serendipitous event. And in fact, it's maybe even impossible to tell at the level of visibility that we have of what's happening inside the businesses. So it's not a perfect method, but what I basically do is I add up the total amount of retained earnings over a 10-year period. I look up at the increase in retained earnings, the increase in profits over that same period of time, and I just allocate as if 100% of that benefit was a result of retained earnings. I know that it's not true, but if a company's retaining earnings and making more money, I'm willing to forgive the fact that they may not be a direct cause and effect. But when you look at this, you'll see that every one of our companies had at least a 10% return on retained earnings using that definition. SAIC had a 77% return. Altria had a 67% return. Deckers was 64%. Some of those numbers seem very high. One of the ways to get a really high return on retained earnings is to not retain very much money. If most of the money you make is being paid to the shareholders and your operations are growing, then you're going to have this massive return on retained earnings. But that's okay, because I want to reward companies that don't require a lot of capital. And if you don't require a lot of capital, you have a big number in this equation. The other thing to talk about is Warrior Met Coal. You see that I've left their return on retained earnings undefined. And the reason for that is Warrior Met Coal is in the middle of opening the Blue Ridge copper mine. It will increase the Blue Ridge coal mine. It will increase, when open, the coal that the company can produce by 75%. They're opening that mine with taking on no new debt, using $750 million of retained earnings over the last several years, and that mine is not yet online. So if I showed you the actual return on the $750 million they've retained, it would be a very unimpressive number. But I know that this mine is opening literally as we speak, and I'm very comfortable that it's going to start throwing off returns, and I'm very comfortable that the money's been used intelligently from what we can tell. And so, again, when you do this much homework, you can start to make some of those value judgments. So let's talk about all of this in total. When our companies make money, they pay us a 3.7% yield in terms of dividends. On top of that, they pay us a 1.1% increase on our future ownership of the company as a result of share buybacks. On top of that, they reduce their debt by $7.3 billion, in addition to saving $571 million of additional cash. So the balance sheet improves by 7.9 million. And then on the money that's left, they actually retain inside the business. On average, our companies are getting a 31% return on that money. So if you look at capital allocation, if you look at our companies and you say, well, boy, our companies don't have any debt. They seem to have pretty stable earnings. They seem to be very diversified, and they seem to be doing a very good job of capital allocation. What I hope you understand is that I am not interested in competing in the S&P 500. I'm not interested in taking that level of risk. If I can have these kinds of solid companies and get us a 14.4% return over the last 12 months and a 15.8% return on average over the last 3 years, I would rather do this and reduce our risk to near zero, which is why we're invested the way we are. I know that I could go buy Tesla and double our money in a year until I can't. And I know I could go buy Palantir and have our money go by 300% a year. But I also know that's not sustainable. I know that these companies, I know we're not going to stop eating eggs. And I know Cal-Maine is not going to stop being the largest egg producer. And so I've opted, because again, I manage my money for me and you guys ride along in the coattails. And I'd rather live like this and be hyper safe than squeeze an extra few points by taking on some risk that I don't really need. So when you add up that philosophy and you look at what I've already determined and explained as the problems with the S&P, the fact that it's no longer really a proxy for the American economy, that it's dominated by a few companies, that 7 companies are 35% of it, that 100 companies are effectively irrelevant. You look at the S&P 500 was up 17.4%, but only because of those 7 companies, and that the equal weight was only up 9%, and we were up 14%. That the average PE ratio should be around 18.7, and it's currently 31. You look at an average PE ratio for the S&P 500's Magnificent 7 as being 73, and you just go, I just don't want that risk. I'm just not going to do it. And so I recognize that in the short term, we might get beat a little bit by the S&P 500, but in the long run, I believe these numbers are going to revert back to the norm. And I also believe our companies, which don't have any hype associated with them whatsoever, most of you have never heard of any of the companies we own, you're going to say, I hope you're going to say, let's just keep doing what we're doing, and it'll all balance out in the long run. This final chart is looking at how I did in 2022 versus the market. Now, in 2022, I was not yet operating professionally. I was not yet licensed. I was managing simply my own money. But if you look in 2022, I was up 5% for the year, and the S&P was down 18.1% for the year. So my attitude is, if I give up a couple of points every year when the S&P is red hot, and then I can really outperform it when the S&P gets in trouble, and on top of that, not lose money, that's a business model that I really am happy operating in. It lets me sleep at night. It lets me go play golf with my investors and have them be happy to see me and me be happy to see them, and not be nervous that they're feeling like I'm taking undue risks with their money. And so that's basically the philosophy that I bring to this money management business. So in summation, we were up 14.4% for 2025. Inclusive of so far this year, we're up 19%, and we're beating the S&P 500 for the last 13 months total. We're up 15.82% over the last 3 years. We've done it with 13 companies with almost no debt, great capital allocation, and I believe very little risk. Due to our longer holding times, we have deferred taxes on many of our gains. The S&P 500 remains tainted by a weighting system that over-rewards one sector and does not fairly reflect the economy. And the S&P is also at historic highs for PE ratio and related to the Buffett ratio. So when you add all that up, I'm pretty happy with the year, and I hope you are too. So I want to thank you very much for investing with me. I want to thank you for your trust, and that's the summation for the 2025 results.